Well, load shedding, 1,000-degree heat, and 100% humidity here in Durban is certainly not my friend. I'm actually parked under a tree trying to get you some of this content that we've been missing out in the last couple of weeks. It's our first episode for 2023 on the Financially Fabulous Females YouTube channel. And today we're going to be breaking down the triple whammy that South Africans are facing. Early on this week, the interest rates have been hiked. The Reserve Bank has made this announcement that they're hiking up interest rates. Inflation is at an incredible level, and here we have the Reserve Bank commissioner indicating that they're hiking by 0.25 basis points. What this basically means is we're paying more to borrow if we have home loans, credit cards, store cards, any line of credit. Now we're now paying more for the same line of credit. Okay. On top of that, we have this announcement made earlier this year, the highest electricity price increase since the last decade. Eskom announcing that almost 19% increase that will be implemented for consumers in April 2023. And you can see on the graph there, cbn.co.za is the source of this. But you can see on this graph how the electricity increases have basically impacted us for the last 10 years or so. It's been horrid because we're getting less and less electricity, more and more crappy service, and the prices are just astronomical. Okay, and all of this is going to impact our money because it's going to be driving up inflation. And the third part of that triple whammy is this one, where more woes for citizens as another petrol price hike increase expected next month, according to the Automobile Association of South Africa. So they're expecting about 57 cents per liter for 93, 52% a liter for 95, and I don't think it's so bad for diesel. Okay, but these three in combination, this is our energy, and it's our money as well. All of this is going to drive up inflation. So when the Reserve Bank hikes up interest rates, we don't see immediate effects in the economy. It's going to be like 6, 9, maybe 12 months before the effects of the interest rate filter down to the economy to reduce the use of credit, to reduce the velocity of money, to try and bring down inflation. Okay, but when you add on this energy increase, where there's literal no exchange in value, but there's higher prices involved, this is gonna drive up inflation, and it's the same with the fuel prices as well. And we see in the months previous to this, there have been slight fuel cuts, but the prices of stuff have not dropped accordingly. So it's going to be hard 2023. If you are planning these major purchases, vehicle upgrades, things like that, I would reconsider. I would not be upgrading my vehicle anytime soon because it's going to be a hard year. And with crisis, remember, if you've been watching our content for a while, you know that when there's a crisis, there's always opportunity. So for me, instead of paying high interest on my credit card, high interest on store cards, and extra money that can go into my investments are now going on these energy costs, I rather position myself to be in a place to capitalize on this coming recession. Because when the recession happens, shares go on sale, assets go on sale, and that's where I want to be to buy low and sell high. Whether you're selling tomatoes, whether you were selling or buying shares, you trading forex, whatever the thing is, you want to buy low and you want to sell high, and that spread is your actual profits. That's how you build wealth, right? So I want to be in that position to be able to purchase these assets on the cheap when the peak of this recession happens. And we find over here, the World Economic Forum, recession 2023, that depends where in the world you are. Now, as bad as recession is, the impact that it will have on the mass scale is pretty negative. But like I said, if you are savvy enough to know where those opportunities lie, you're going to capitalize on that. And as they say, where in the world, it's not like, the World Economic Forum, they have their own agenda. Of course, if you this is an organization you follow, you would know that. But in our case, as South Africans, with our failing infrastructure, although we have this January 2023 triple whammy, in the next couple of months, wherever you are in the country, your municipality is going to be looking to increase the prices on top of that. I'm in Etikweni. they add on to this escom price. They increase our property rates, and they're going to be looking to increase. So the value that we're getting from the services that government should be providing is not there, but the price hikes are coming, and that is picking up inflation. So let's have a look at what the World Economic Forum is saying. Recession in Europe. Well, Europe, they have this whole thing happening with Ukraine, with Russia, and the predictions from the World Economic Forum, that their outlook is a global growth was trimmed by 0.2 percentage points, while the forecast for the eurozone was revised dramatically down to zero point 0.5 from 1.20. All right, so there's going to be opportunities in Europe. Remember that the content of this video, anything of mine that you hear online, is not financial advice. So where I see opportunity here is one euro stocks. Okay, if they've revised this forecast down, what will happen is it's market perception, and the markets will react accordingly, and I will be looking to capitalize on euro stocks. The IMF has forecast global growth slow down to 3.2% in 2022, 2.7% in 2023, from 6%. That's a huge jump, all right, on global growth. This is the weakest growth profile since 2001. And why that time period is significant, because there was a slight drop in 2000 with a Y2K drop. Then there was the whole 9 and 11, the US stock markets crashed. Yeah, and the big one for the last 2 decades was 2008, where it started off in the United States and then it spread globally. I mean, it took about 18 months to reach South Africa, but it definitely felt an impact. And if this is the worst predicted point, higher than 2008, we are going to really be in for a rough 2023. And this is just for the rest of the world. If we go on to read this article, let's look at it. Where do the chief economists expect the risk of stagflation? Sub-Saharan Africa. I mean, we're driving a lot of that. Expect high inflation, 33%. Expect weak economic growth at 68%. Look at weak economic growth for United States, 91%. Inflation not so bad. Latin America and the Caribbean, weak economic growth, 68%. China, East Asia and the Pacific, 37%. That's not bad. South Asia, so India, Bangladesh, Sri Lanka, their low economic growth that expected is at 15%. Okay, so plenty of growth potential there, because their risk for weak economic growth is a little bit low. Europe at 100%. So like I said, opportunities. Once it drops over in Europe, you want to be buying. Once it drops over in the United States, you want to be buying. South Africa, I think they already predicted a 2% drop in GDP because of the whole energy crisis. It's rolling blackouts since September, and it's only going to get worse. I remember reading an article where they're talking about stage 10, stage 12, and I can just imagine the humidity at that time, right? It's going to be horrible. Here's some of the business challenges that the World Economic Forum is predicting. They navigating a new landscape. 100% of geopolitical fault lines will continue to realign global economic activity. 63% global recession, chance of a global recession in 2023. 91% weak demand. Okay, so that's huge for manufacturing, for production size things. 87% high cost of borrowing. Now, although South Africa did raise their interest rates this week, the rest of the world is doing the same thing, mainly because of their inflation, and places like the United States, the UK, they've been printing money to fill in the gap while people were at home during lockdown. While we were not exactly printing money, but we were giving away money for free with those grants. And when there's not a clear exchange in value, that's the kind of thing that drives up inflation. And this is how businesses will react. 86% reduce costs by cutting operational expenses. Now we see this happening in the tech sector in the United States. Facebook laying off people, Amazon laying off people, Twitter laying off people. I think it's only Apple that hasn't laid off as yet. But hopefully they don't. I mean, it's not nice when people lose their jobs, but this is the reality of the business environment. I mean, as a small business owner in South Africa, I'm horrified to grow my business, because one, I have to hire more people. How do I hire more people in a recessionary environment? I need technology to survive. I mean, to really back up electricity supply or power supply to run my business, to run the office, is a huge investment, and I'm not ready to make that. I need cash during times of recession because clients are uncertain. Okay, obviously for bigger businesses around, uh, they're thinking along the same lines. Managers are thinking of along the same line. Should we be hiring at this point? How do we cut our costs? Is a recession coming? And you should be thinking along these lines for your household. The 78% will be looking to lay off workers. Another 70%, 77% to optimize the supply chain. So, look, it's going to be a tough 2023. We can only look forward to brighter things in 2024. The best advice I can give you, this you can take as advice, right, is pay down your high interest debt. Uh, Live simpler. I mean, it's going to be a hard year in South Africa. Maybe if we dip into recession, I mean, recession, like I said, comes with opportunities. The problem we have as South Africans is coming out of that recession where we don't have the infrastructure to keep the lights on, to keep the power running, to keep production running. And that has a chain effect. If the factories can't work, they're going to fire people. Those factories are closing down, the suppliers are affected, and it's that whole value chain, and it's just a messed up situation. So please, if you have not planned for 2023, you got to plan for it. Prioritize paying off debt. If you haven't done that, try and hold cash to until we reach the bottom. And I know, that being said, it's very hard to time the market, but you can use other strategies such as rand cost averaging to continuously be putting more money into your investments as it's going down, and you entering the market at different points, and also continue to put in money as the market, as that wave comes up again. So that's a great strategy to hold in the long term as well. Stay away from credit. Right, that's a big one. Stay away from credit. Don't be in a rush to buy a house, to buy a car. Put off the cell phone upgrades. Just live on the basic. Cut down your household budget. I know it's not easy. Inflation is driving everything up, but just continue to educate yourselves about what's coming, and brace for impact. And if you positioned yourself in the last couple of years, look out for those opportunities. And I'm going to be letting you know about all those opportunities on this video podcast. So make sure to like this channel, to subscribe, so you'll be notified whenever I put out some new content. And I'll catch you soon.